And Mark, you put out a pretty concerning note over the weekend where you talked about we're in a situation where we're damned if we do, we're damned if we don't. You want to explain that?
Certainly. The Fed is raising rates very aggressively to combat inflation, which is, in my mind, one factor, but not the only factor. Raising interest rates are going to have a tremendous effect, a negative effect, on corporate revenues, corporate profits. Mortgage rates are at 6.3% now for a house. It's going to have a very bad effect, in my opinion, on, as I said, corporate earnings, and also the bond markets are going to go up in yield, down in price, which is also going to have a very negative effect on savers and investors. So I think the Fed is way too focused on inflation by itself, and they need to consider what it's going to do, what these raising of interest rates is going to do to the rest of the economy, or they risk throwing us into a recession, causing bankruptcies with a lot of high-yield companies, and it's going to be a very difficult time. So we're damned, as you said, Becky, both ways.
Yeah, I mean, I think about that. It puts the Fed in the position of having to choose winners and losers again, I guess, although you could almost say the high-yield companies kind of put themselves in that risky situation, thinking that these rates were never going to change. When you look at inflation, it kills every company, including small businesses that also risk going out of business because they can't keep up with labor and input costs.
Right. I think the best move the Fed could make is to say, here, we're going to raise interest rates this time. The consensus view, of course, as you just said, is 75 basis points, and then say we're not going to be raising rates again until the end of the year, first of next year, so the markets can readjust, companies can readjust, borrowing can readjust, and we don't get thrown into some kind of recession because the Fed is combating inflation and not paying attention to the rest of the corporate market.
I hear your point, and I want to dig in a little deeper to what the implications are going to be. But is this a case of the market not listening to what Jay Powell has been saying for some time? They've been saying that they're going to raise rates. Every Fed speaker I listen to basically says those rates are going to be higher than the market's anticipating. They're going to last higher for longer. If you haven't readjusted already, were you just the fool because you didn't believe the Fed?
Well, Becky, I don't think it's just a question of not believing it. It's a question of somebody has to refinance their debt and the bonds are coming up, or if somebody's going to get a loan at the bank, you know, you can listen to what Jay Powell says, and I certainly do, but I think that the Fed has to pay attention to what their actions are going to do to the entire economy. Otherwise, we're going to risk getting thrown into a recession, and the question then is higher inflation or a recession more damaging to the American economy. Also, it's going to raise the rates for our government's borrowing. And, you know, all across the board, there are two sides to this question. And I think that the Fed is ignoring the side of the question of what it does to the economy when they're in this rush to raise rates just to combat inflation. Inflation is one issue, but I wish the Fed would concentrate on the entire package and not just the one issue of inflation.